The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. Energy escalation. Iran targets Qatar's main LNG export facility, one of the world's largest, after an Israeli attack on the South Pars gas field, also one of the world's largest, leading to a stern intervention from the US president. European equity markets line up a day in the red amid renewed uncertainty after ending a two-day winning streak.
The Federal Reserve keeps its key rate on hold and pencils in a single rate cut this year, with Chair Jerome Powell addressing the inflationary impact of the Iran war.
The implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy.
Let me frame up the next 2 hours for you. In fact, let me frame up all of CNBC programming today for you. If you've got the world's largest LNG export facility being hit in the Middle East, and you've got the world's largest gas field potentially being hit or hit like you've never seen, according to the president, if there is an escalation, it's hard to think how markets, policymakers, companies can price that into future expectations as well. And as such, of course, a lot of people feel very cautious about risk assets, given the fact that the world's largest gas field and the world's largest LNG export facility could potentially both see an escalation and more violence upon them. Oil and gas prices are pushing higher this morning amid escalation in the Middle East, with key energy facilities across the region coming under attack. Israel on Wednesday struck Iran's South Pars gas field, sparking threats from Tehran, which vowed to retaliate against energy infrastructure across the Gulf. Qatar said a ballistic missile attack from Iran on its key Ras Laffan industrial city caused extensive damage, with further strikes this morning hitting several LNG facilities. Saudi Arabia and the UAE have also reported incidents. There was an extraordinary Truth Social post from the President Trump overnight. He denied any prior knowledge of Israel's attack, saying it wouldn't happen again, but also threatened to, quote, massively blow up, not just blow up, massively blow up the entirety of the South Pars gas field if Iran continues strikes against Qatar's energy facilities. European equity futures are called down yet again. Dan, Emma, your brilliant cohort and co-worker who runs our team, of course, in the Middle East as well, and you have done some amazing work, but Emma sent through to the team today some of the stats regarding South Pars and the North Field and Ras Laffan, and they make very sober reading given the fact that they've both been targeted in the last 24 hours.
Exactly, Steve. These are critical pieces of energy infrastructure, and in Qatar's experience, of course, absolutely critical for the functioning of the state. So with this most recent escalation, obviously the worry in the region is that this situation seems to be turning from bad to worse. And as you say, overnight we have seen Iran escalating its attacks on these critical pieces of Gulf energy infrastructure. That ballistic missile struck Qatar's Ras Laffan industrial city, as you say, the world's largest LNG export hub. Qatar Energy has said there has been extensive damage there and fires, but thankfully no casualties. Of course, have to remember though, that site has actually been offline since March, and this latest strike certainly makes any near-term restart unlikely. At the same time as well, here in the UAE, we saw missiles targeting another gas facility as well. In fact, 2 gas facilities here, clearly undermining the energy security of this part of the world. At the same time, the political fallout here is also continuing. the Saudi foreign minister using some of the strongest language we've heard yet, saying that any trust that Iran had remaining has effectively been shattered. Of course, the Saudis now reserving their right to respond, he says, politically or non-politically as a result of this escalation and the attacks that we've seen inside Saudi Arabia as well. And of course, the UAE also echoing that as well, calling this a terrorist incident. So in the last 12 hours, it does appear that there has been quite a significant tone shift inside the Gulf as well. All of that off the back of what was a piece in the Wall Street Journal yesterday quoting Dr. Sultan, the CEO of ADNOC, who said that Iran's ability to hold the Strait of Hormuz hostage effectively constitutes global economic warfare. So the tone has shifted in the Gulf. Clearly, these leaders are furious. They're angry that their critical pieces of energy infrastructure, again, the economic arteries of these very countries, is being targeted by Iran. Meanwhile, in Washington, the president also changing his tone a little bit here as well. It's been interesting to see NBC News reporting that the president was fully aware of Israel's plans to strike the Pars field, and in fact reporting that the president actually signed off on this. And then to see him take to Truth Social, reversing that, attempting to distance the United States and Qatar from this most recent attack. So, of course, the escalation risk remains. It's part of the reason that we've seen oil prices continue to stay elevated here as well. And, of course, Brent crude hitting the 100-plus mark through the course of the Asia session and likely staying elevated through the European trading day too.
Dan, I don't know if you know the answer to this question, but I'm going to ask you anyway. Who is the UAE and Saudi and Qatar and Kuwait most angry with? Is it the Iranians for their retaliation, or is it for Israelis making the attack, or the US president for not being able perhaps to do what the administration said it would do and keep oil and gas flows going and actually make the only very temporary price spikes? Because it's looking at the moment, and we've got a screen up at the moment with all the energy moves of the last 24 hours, it's looking like anything but temporary price spikes.
Exactly, and the mid to long-term risk here is still being assessed. In terms of who they're most angered by, well, it's probably a combination of factors here. First and foremost, it does appear that there would be some apprehension given Israel's strike on South Pars. The fact is, these Gulf states know how the region works. They would have expected some kind of retaliation as a result, and that retaliation has come on their own energy infrastructure assets. So, of course, there is concern about Israel's approach and whether or not it is directly in line with what the United States is trying to achieve here. At the same time as well, coming into the conflict, the objectives of Operation Epic Fury were never really clearly articulated to these Gulf leaders either. Of course, the UAE, Saudi Arabia, Qatar, very closely aligned with the United States militarily, economically, and of course you would expect some alignment with this White House as well. But of course, there's probably also some confusion about exactly what the president is trying to achieve here as well, and what the end goal is here, given that we've already seen a decapitation at the top of Iran's leadership structure, and now the president is talking about putting boots on the ground as well.
OK, Dan, thank you very much for bringing us up to date on all of that. And crucially, all of that happened when it was too late for the markets on Wall Street to fully digest it. So what you're seeing from here is the results of a pretty dismal trading session before all of this. Now, let me explain, because the Dow it came down to a fresh 2026 low, reflecting those inflation fears taking hold among investors. It led the losses down more than 1.6% in the session. And crucially, that closing point is below the 200-day moving average. Now, technically, that means that the expectation, or it points to a negative path forward for the market. But the sell-off was driven partly by greater inflation fears, which were flagged by the Federal Reserve, the scaling back of expectations for the Fed's future rate cuts, or even with the central bank indicating that it would still likely cut one more time this year. That wasn't enough to assuage those concerns. There was also a hotter than expected wholesale inflation reading. The producer prices index for February came in at 0.7% versus expectations of 0.3%, and that was higher than it was in January by a couple of percentage points. And remember, that higher wholesale inflation cost does not reflect the current energy spike that we are seeing. Let's flip the boards and see what's going on in Asia, because the Asian markets are tracking those losses on Wall Street. Some downward pressure coming on all the main benchmarks. The Japanese Nikkei down by the most 3.4% nearly there, and we'll keep an eye on that for you. But those are the numbers as they stand at the moment.
The Federal Reserve has kept rates on hold, but has flagged it still expects to cut rates before the end of the year, as Ben was just saying. The central bank's dot plot indicates a single rate cut for 2026 as it grapples with uncertainty around the Iran war, sticky inflation and mixed signs from the labour market. The Federal Reserve also upped its outlook for the year, expecting GDP across the United States to grow 2.4%, up from the previous forecast in December, whilst inflation on the key measure of PCE is now expected to hit 2.7%. Fed Chair Jerome Powell addressed the ongoing conflict in Iran and the potential impact on the US economy.
The implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy.
Well, that was the Fed. We're actually now gearing up for a massive day of other global central bank action as we wait to see how policymakers will respond to the impact of rising energy costs as the war continues in the Middle East. We've already had a decision from the Bank of Japan overnight, which kept rates steady. Later today, we'll hear from the ECB, the Bank of England, the Swiss National Bank and Sweden Riksbank. Joining us now, Andrei Szczepaniak, who is Senior European Economist at Nomura. So far, Andrei, I suppose what we've seen from the Fed, from the Bank of Japan, is in line with what was expected. The banks aren't going to make any dramatic moves that are going to shock the markets, are they? What are you reading?
Look, I think in terms of the sort of policy decision making, we think all the banks today will essentially stay on hold. So no change in policy. It's all about really gauging the extent to which they think what's going on in the Middle East conflict, this spike in energy prices, how that's going to feed into inflation, into growth. And I think from the central bank's perspective, you have the trade-off. Bearing in mind, we have very much fresh in our minds that 2022 energy crisis in Europe, the spike in inflation, we saw how central banks in Europe responded. The question mark really is, how long will this conflict endure for, and what could we see coming from central banks going forward? It's worth bearing in mind, prior to the conflict, we had expected the BOE to cut rates today. Obviously, following the start of the conflict, we changed our call and in line with all other sell-side firms and also market expectations. In terms of other central banks, I think for the RBA earlier this week, they raised rates. Now, the RBA, prior to the conflict, had been expected to raise rates sometime this year, but not necessarily at this meeting. They did so on the balance of risks due to the spike in inflation, well, due to the likely spike in inflation from the energy crisis. So the issue now is going forward, what could happen?
And so in terms of any possible playbook that they could look to, how does this compare with the energy crisis that we saw in the wake of Russia's full-scale invasion of Ukraine? Can they take that off the shelf and go back and say, look, this is what we did here, we can follow that path that we took then?
I mean, look, markets are certainly pricing that in. So for the ECB, markets are pricing 2 rate hikes by the end of the year. For the Bank of England, markets are pricing almost 1 rate hike. It is different this time around, though. So firstly, it's more oil in some senses. So oil prices are higher versus what they were then. Gas hasn't risen to those same sorts of levels, but there's clearly the risk, in particular, should the conflict actually escalate further, as we're seeing happening now overnight sort of thing. So I think from that perspective, and it's also worth bearing in mind, Christine Lagarde did say only 2 weeks ago that the ECB will not allow the same sort of inflation we saw in 2022 to occur this time around.
With respect to Madame Lagarde, if oil prices go significantly further and LNG prices go significantly further north and logistics prices and fertiliser prices and every other input cost goes up, with respect to Madame Lagarde, she can't control that, can she?
So I think what she's really trying to say is that, bearing in mind last time round they were seen as being behind the curve, the ECB took a long time to actually eventually raise rates. This time round, they're going to be much more proactive. And already we had Kazakhs, for example, one of the governing council members, speak about raising rates, even if the Q4 28 forecast is still at 2.1%. It's a case of raising rates earlier if necessary to ensure inflation expectations do not de-anchor.
But inflation expectations will go up, even if they aren't de-anchoring. And at the same time, one argument I've heard from many people sitting in that seat is don't worry about inflation because there'll be a demand side response and people will stop buying stuff. Hence, there'll be a demand side response which will cap inflation. Well, that sounds decidedly like a stagflationary environment to me if we have got all these other input. And again, I don't want to paint the worst scenario. I'm actually an optimist by heart, would you believe? But actually, I can't see any of the other scenario, cateris paribus, at the moment, than stagflation.
So I think it's clear that obviously as you see prices rise, people will likely pull back on consumption, and certainly Europe is very much, I would say, vulnerable to the situation. We're heavily dependent on energy imports. And actually the pass-through from spot Brent and gas prices into HICP inflation is contemporaneous and very elevated in the UK and the euro area. The US is slightly more, I would say, insulated. So for example, Dutch TTF has risen, but actually Henry Hub hasn't risen to the same extent.
Actually, for our viewers, the US doesn't look insulated on gasoline prices. It doesn't look insulated on actually even gas prices. It doesn't look insulated on diesel prices. For our US viewers who they are here, bonkers as they are, up at 3 a.m. in the morning. Why are US prices moving up quite aggressively as well?
So in terms of the in terms of natural gas prices, those haven't risen up too much, to be fair, I would say. That's much more muted.
Gasoline's at 385 rather than...
So gasoline, so they're the version of petrol. So when I say natural gas, I mean...
Yeah, I know. Sorry, it's a language problem. It's my problem. My fault, yes.
But yeah, so essentially gasoline or petrol prices, so pump prices basically, those are traded on the international markets. And so from that perspective, that's why we are seeing those prices rise in the US. And so from the US perspective, it's a challenge. Well, they will see higher inflation, and clearly that's going to feed into Trump's reaction function for the midterms later on this year. That said, we think the US consumer is much more resilient. Growth in the US has been very strong. The past couple of years, certainly stronger versus expectations. We saw last night, for example.
Sorry, Andrej. Is the US consumer resilient, or is that being masked by the fact that there's a 1 to 10% at the top end of the upward leg of the K that it's flattering to deceive what is going on for the 90 to 99% of the bottom leg of the K?
There are always distribution asymmetries within the economy, I would say. However, at the previous FOMC meeting, even the minutes did suggest that there's less concerns now of a K-shaped economy in the US versus what the FOMC had previously thought. So those concerns are receding somewhat. And obviously, the issue is this, essentially, policymakers always make policy for the aggregate. I would say this, monetary policy is about the aggregate economy and fiscal policy is about redistributional effects within the economy, I would say. But yeah, so from the FOMC's perspective, it's a case of monitoring this, and in generally speaking, the US consumer has been stronger, hence why the FOMC has revised up their growth forecasts. It's much more Europe which is really vulnerable to the risk, and we see now actually already some headlines from Italy, from France, where they're trying to actually put price caps on pump prices.
Andrej, I'm going to ask you a question which it may be slightly unfair, but I will ask you anyway, and let me know if you can give an answer. Of the central banks, there's so much going on this week. They've all got challenges. Which of them is best placed going into this crisis and this challenge, and which has the biggest challenge?
I would say, in terms of the one that's maybe best placed going into the crisis in some senses, the Bank of England, to be fair. So they were still in the easing cycle going into the crisis. And so rates are slightly restricted to some extent, which means obviously as inflation rises, there is still some buffering from that perspective. In terms of the central bank most at risk potentially is the ECB, as they clearly have a credibility concern at the forefront of their minds, given what happened during the last energy crisis. And you can see now immediately they're very concerned about not repeating the exact same mistakes as last time round. And so I think that's the sort of tool to watch out for. Okay.
Andrej, thank you for fielding that rather big question. Andrej Szczepaniak, Senior European Economist at Nomura, thanks for your thoughts. Do stay with us. Still to come on the show, EU leaders get ready for a crucial meeting in Brussels. We are tracking the latest. Plus, more on what to expect from 4 key central bank decisions here in Europe. And we'll get another check on the defence sector with the CFO of Germany's Hensoldt. That conversation coming up at 8:15 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's Miss Jo Malone at CBE.
I started that first business of skincare. That's when I knew that I was in charge of my own life. And that's when the entrepreneur really, although I didn't know what the word entrepreneur meant, that's when the entrepreneur really took hold.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
The industrial defence group Rheinmetall is racing to meet demand for its air defence systems. CEO Armin Papperger told CNBC that international stockpiles of missiles, gun-based systems and interceptors have been depleted or near emptied in the wake of the war in the Middle East. Speaking exclusively to Ritika at the BofA Global Industrials Conference in London, Papperger laid out his view on the war in the Middle East and where the most demand for its products was coming from.
There is a change, it's a big change, and the first change is on the air defense side, because what they learned, all the countries in Middle East, it's very hard to defend against drones with missiles. So you need a mixture of missiles and gun-based systems and maybe also interceptors. And this mixture is a good opportunity for us, because we have gun-based systems, we have missiles, and we will invest more in missiles, and we have interceptors. So this mixture will help us for the next years a lot to grow our business in the Middle East.
And where is the demand coming from right now? Where is it? Europe, Middle East, the US? Where the biggest demand?
I think that at the moment all Europeans, Americans, and also Middle East stocks are empty, or normally nearly empty. And there is a huge need on missiles, there is a huge need on air defense systems, and it will come from everywhere.
And talking about the timing of these new orders that you're seeing, given we don't know how long this war is going to last.
Nobody knows, but if it lasts another month, I think we nearly have no missiles available. And the reason is also simple. If you have a drone, the price of a drone is a very, very low price. So you can produce, I have a simple calculation, if you produce 60, 70,000 drones, and the price of a drone is $20,000 or $30,000, it's nothing in comparison to that what you have to fight against. So the business has to come very fast.
So if this conflict de-escalates soon, how quickly do you expect orders to be delayed or cancelled or just simply redirected?
No, I think we get extra orders, on top orders, and it will be not delayed. My expectation is that over the next weeks the first orders will come. My team is at the moment in Middle East to negotiate with the partners, and all countries in Middle East are interested to get more of our systems.
Talk to me about this anti-drone interceptor interest that we're seeing since the Middle East conflict began. I mean, is that changing the defense industry's focus right now? And what lessons can we learn from Ukraine on this?
There are lessons learned, and one thing is that with drones a new effector is coming. That is very clear, a very cheap effector. It's not as cheap that a lot of people think, because the cheapest thing is still, let me say, artillery ammunition. This is much cheaper than that, if you don't speak about the small quadrocopters. But artillery round costs, full cost shot to bring a lot of energy into the target is $3,000. If you want to have a drone on category 2, at the moment in the Western world, the price is more than $40,000, $50,000. So it's a big differentiator on price. But it will come, and this is what we learned, and the Ukrainians are very effective with that ammunition. And they are very effective because the Russians at the moment has not a good, very anti-drone strategy.
So how much of a game changer do you think it is?
It's a small game changer. It's not a full game changer, because what I believe is you need a mixture. You need a mixture out of all types of ammunitions and all types of protection. Then you are well prepared.
Ritika also spoke to the CFOs of Thales and Airbus about how they are coping with the surge in defence demand.
We need to recognize that all of that is pretty new. So we need to be a bit cautious on the impact and what it means for our business overall. However, we can say that first, it is a confirmation of what we have seen in Ukraine relative to air defense. Air defense capabilities are becoming more and more essential. and also having to deal with many different types of threats, moving from slow-moving drones to hypersonic and ballistic missiles. And what countries need to be ready for is really to address the spectrum of different threats. And this is basically what we do at Thales. And maybe, the second emerging element that we see is also the need to get protections against mines. It's true, this is a topic that we have not seen in the past for quite a while, but we have seen what it means, to have to deal with mine threats. So mine hunting capabilities is also a capability that is emerging from what we have seen in the Middle East. And the good thing is also Thales is able to provide, the right solutions. We have been equipping, in particular UK and the French navies, on the most updated generations of autonomous mine hunting capabilities, combining drones, robots, all of that driven by artificial intelligence. So this is also, for us, an emerging trend that could develop business overall for our company.
I think what we said is still true, that the entire supply chain has improved, and that's the good news. Unfortunately, we're down to one supplier who is struggling to deliver the engines that we have ordered and where we have a contractual right to receive them. So we're in constructive discussions with Pratt & Whitney how to resolve the issue, but currently this is the limiting factor, and this is why our guidance for 2026 is 870 deliveries and not more.
And is that heading towards a legal dispute then with Pratt & Whitney?
I would say we've got a long-standing relationship with Pratt, and of course we're always trying to find constructive solutions. So therefore, while every party is probably protecting their legal rights, of course the ambition is to find something which is a mutual consensual agreement between the two parties.
Are there any other bottlenecks in your supply chains right now, or is it just the engines? There was some issues, I know, with the fuselage previously, or is that now resolving?
I would say the supply chain has significantly accelerated. So the good thing is everybody is supporting this rate 75 that we want to go for our narrow-body aircrafts by 2027. There's always smaller issues. For example, cabin interior for business class seats sometimes still presents a problem, but usually it doesn't hold up production and deliveries. It's maybe sometimes cumbersome to install these seats at a late stage in the process. But really, what is the pacing item as of today is engines.